So I just wanted to say before we begin, it is important to note that the topics that we're covering off today is general in nature and it doesn't take into consideration of your situations and needs. At the end of this webinar, if you feel that you need some help, please feel free to contact us. We are always here. So there is a few things that I want to cover off today. Why and how women are different when it comes to creating wealth, how we can plan for these differences. We'll also discuss how to get into some good financial habits, and we'll look at the importance of seeking help along the way and selecting a good financial planner. So let's jump straight into it. So why are women different, and how we and how our lifestyle have changed over the years? What's the difference between the baby boomers and the generation X, Ys and Zs? Well, let's just say it's a completely different landscape. As you can see, things were very different for our parents and grandparents, and each generation faces different challenges. Women from the baby boomer generation, in most cases, were financially dependent on their husbands, who generated the income for the family. And they were also responsible for building the asset pool that they would live off when they retire. So when you compare that to where we are now, we tend to marry and have kids later. We're more career focused, we're more educated, and there's definitely more single women on the rise too. So our attitude to money is different because we're more independent. There's also the difference between men and women's income. You may have heard about the wage gap, which impacts on our wealth accumulated via super. There are a number of different issues affecting women's super, such as having career breaks. Many women return to work in a part-time capacity while they care for their children, or they take the time out to look after their elderly parents, as that task is usually left to the female in the family too. Now, not to mention women often work in lower pay industries such as nursing and teaching. And women live longer, meaning we actually need more in super. So back in 1909, the statutory life expectancy for a 65-year-old lady is only 78. If we fast forward that to 100 years, and the life expectancy age has increased to age 87. That's an additional 9 years that we have to cater for. Now let me explain what statutory life expectancy actually means. So if you get, a bunch of ladies who are 65, half of these ladies would still be alive at 87, but the other half wouldn't have made it. So for those lucky enough to reach their statutory life expectancy, you actually have to make your money last a lot longer than the age 87. So with that in mind, let's talk about some habits on what we can do now to help you start saving. We're all so busy these days looking after family with kids' sports and dance recitals, school drop-offs and doctor appointments. And if you're having to look after the elderly parents as well, then that's something else you have to manage. Sometimes it is difficult just to concentrate on anything else other than putting one foot in front of the other, keeping functioning as normal as possible. But putting yourself first every now and again is vital. If you take the time to think about your own finances and goals, it can only put you in a good position to move forward. And the sooner you do it, the easier it will be. Take the time out and have a think about where you are now. Like, what debts do you have? What income do you earn? How do you spend your money? Can I just ask everyone a really quick question here? I'll pop up a poll. Has everyone done a budget here? So there's a bit of a mix here. That's really good. 50% struggled, have done a budget and struggled to stick to it. It's really quite common. So it's really interesting. So once you know how much money you have and how much you're spending, only then can you really start thinking about how much you can afford to put aside and save. There are apps and web pages that can really help you do that. my favourite website is the government website called MoneySmart. It's a great place to start. They've actually got a budgeting tool there as well, so feel free to go on there and have a quick look. Just have a go. I mean, it's really not as hard as some of the other websites that are available, so really user-friendly. And since you're there, have a look at the other tabs as well. It's got loads of other really interesting information. Okay, so once you are ready, start to think about some options and low-cost bank accounts so that you can start putting money aside on a regular basis that really isn't going to cost you an arm and a leg. I remember years ago, I was talking to this client of mine and she said to me, gosh, Sandy, I know I have to do something, but I don't even know where to start. So I understand that it can be really scary to navigate through all the information that's out there about how to save, because there's just so much of it, and like, where do you even start? So I guess that's where we come in, and we can help to improve your knowledge about finance. Like today, take advantage of these type of education sessions we provide. These sessions and other topics are usually announced through our newsletters, which it's usually emailed through. So if you're not getting them directly, please call us and we'll make sure that we have the right email address for you. What we'll do, we'll put our contact details at the end as well, so you can just email us. Another thing is to actually read your super statement that you should get once a year. You don't need to know it intricately. I certainly don't go through it with a fine-tooth comb, but you should be aware of what you're invested in, how much growth assets is in the mix, what returns that you get, how much is being paid to your account. Other things are like, how much insurances do you have? Do you have a beneficiary nomination on there? Now, if you don't understand it, you can always call the super fund for an explanation, or you can call us. So a tip is, if, say, for example, you have 20 years till retirement, which is a long time, do you really need any defensive assets in the investment mix? Defensive assets are the things like cash, fixed interest and bonds. These are the assets that are a little less volatile and provide a lower return when you compare it to, say, the growth assets like properties, Australian shares and international shares. So if you want your super to work as hard as possible for you, you could consider increasing the growth asset exposure. And what your money is invested in will have a big impact on how much you have at the end. It is important that you have an understanding about investment risk and what that actually means. And in a nutshell, investment risk is the chance that your investment may drop in value or doesn't keep up with inflation or won't be enough for you to draw a reasonable income in retirement. Now, risk isn't a bad thing. You just need to understand how it affects the returns. The graph on this slide shows the different types of the asset class that I mentioned before and the correlation between the risk and return. Now, with defensive assets, as shown on the assets on the left-hand side of the graph, the cash, capital stable stuff, the lower the risk of volatility, so you would expect lower the potential returns. Whereas the growth assets, which is the assets on the right-hand side, you're exposed to a high level of risk that you're rewarded by high potential long-term returns. So with the increased possibility of higher returns, you must be able to accept that you have an increased possibility of a loss as well. Now let's look at another practical tip that you could consider for your super. Apart from your property, if you're lucky enough to get into the market, that is, your super is probably going to be your biggest asset. So let's get started on that as soon as possible. You could search for any accounts that you may have forgotten about by logging on to the MyGov website. It's usually as part of the ATO, so just click on the ATO link and it will take you to a page. And if you have multiple super accounts, it's really easy following the instruction to consolidate it. Bringing it together will make sure that you don't lose it again and potentially paying duplicate fees. But please be careful of the insurances though. You don't want to lose any of the insurances that you might actually need. Also make sure that you have your tax file number on your super account so that you don't get charged the penalty tax of 32%, which is on top of the regular 15% contributions tax that you already pay. So once you've done that, have a think about whether you can make additional contributions into super as well, on top of what your employer is already making for you. One method is salary sacrifice, where you ask your employer to put an amount you want into your super account rather than paying it into your bank account. So this means your take-home pay is lower, but it also means your retirement pot is getting bigger and working harder for you. So the return that you get straight away from doing that is the tax savings between your marginal tax rate and the 15% contributions tax. I think it's easy if we kind of have a look at numbers and an example. So we have Marianne here. She's 35, earning $55,000 a year. We have assumed that her salary will increase each year with inflation at 2.5%, and her super fund earns about 7% annual earning. So over 25 years, simply by contributing an additional 4%, which is the equivalent to about $42 a week, her super balance by the end of the 25 years would have grown by an additional $96,000. Now imagine if her salary goes up by more than 2.5%. Just push that orange line a little bit higher. And now imagine if she increased the salary sacrifice contribution by more than that $42 a week. It will push that up even more. So you can see how those little changes can make a big difference to the end result. Also, when you start to invest is also really important. I mean, the earlier you start, the easier it is. So that's thanks to the power of compound interest. And in simple terms, that just means you're earning interest on top of interest. Now we have a different couple here. This is George and Sarah. They're both investing $5,000 into a managed funds, again earning 7% per annum, and they add an additional $1,000 each year until they turn 65. Now because Sarah's smart and she's been attending all these seminars and she knows to start early, she started when she was 21. And George is a little bit behind. He starts in 10 years later when he's 31. And by the time that they're both 65, Sarah's projected investment is worth about $173,000 more than George. So I guess the moral of the story here is to start early. Now the next tip is really important to me, and that's getting insurances. Your ability to earn an income is your most valuable asset. Without it, no amount of planning you do can get you into a better financial position. And this is really important to me because I have a client, she's probably my youngest client, and I'll call her Jane for today. She was a normal young girl, enjoying her life, and when she was 24, she became totally and permanently disabled. She had little super because she'd just started working, and she hadn't really thought about super because retirement was so far away. And I guess what saved her was her total and permanently disabled insurance that she got as part of the corporate super account. Now she and her husband, who is now her full-time carer, relies on Centrelink benefits and her super with the insurance payout to survive. So this payout is probably going to be her only asset that she's ever going to have, which is pretty scary, right? So I can't stress this enough. So if you are young, you still need to think about insuring yourself for the worst case scenario because it does happen. I've got a couple of stats for you that might interest you. More than 1 in 5 families will be impacted by an insurable event in their working lives. Over 1 million working age parents with a dependent will be impacted by death, serious illness, or accident. Just under 236,000 working age parents will suffer serious illness or injury every year. So again, these numbers are pretty scary. So have a look at your super statement to see what you currently have. And the question you have to ask yourself is, do I have enough? And if your answer is no, you need to come and contact us. Now, if you've built some wealth, it's important that your money is passed down to the intended person. Having a will provides you with certainty and directions to your family as to what your wishes are. And this is really important because having instructions for your loved ones at a time when they're grieving for you will help minimise this level of stress that they're experiencing. So it just makes a really stressful situation just that little bit more bearable. So another tip is to make sure you have a beneficiary nomination on your super account, and that will just cover your super balance and any insurance payout. Tip number 8 is to develop a plan. So having a plan will give you direction so that you know what you're working towards. What are you achieving? So our tax and super system can be quite complex, so getting good advice to help you navigate through your finances can make a really big difference. It saves you time as well and to avoid those expensive mistakes. Now, we can offer information on a range of money matters from personal budgeting and investing to planning for retirement and protecting yourself with appropriate insurance cover. We can also help work through your finances if you've just received an inheritance, recently divorced, or just lost a partner. If, however, you are struggling with money problems like making ends meet or debt spiralling out of control, a financial counsellor, which is a different thing, can help you get back on your feet. Again, the Money Smart website has some information that can lead you to the right direction. So speak to a financial advisor at Lifestyle. We can really help you identify what is important to you, which sometimes can be quite hard to articulate. Then we will develop a tailored plan for you and help you to put that into action. And more importantly, we can help you to avoid those very expensive mistakes that sometimes can be impossible to fix. We'll also review your tailored plan on a regular basis, as we know one thing is for sure, that things will change and your plan needs to change as well. So it's really important that you take control of your finances, understand what you have and what you can do to save for the future. So you know that saying, money won't buy happiness, which I think is true, but it does give you choices and financial independence. I know that's what I want. Thank you so much, everyone, for attending today. We really do appreciate everyone taking the time out to learn just a little bit more about finances. Thanks, everyone.